There are 6 major Social Security changes coming in 2026, and if you rely on Social Security now, plan to rely on it soon, or even if retirement still feels far away, these changes matter more than most people realize. This isn't background noise, and it isn't the kind of update you can ignore and catch up on later. These changes affect how much money you receive, how much is taken out of your check before you ever see it, and how much of your income ends up taxable. Social Security adjusts something almost every year, but 2026 is one of those years where the combined effect of multiple changes can quietly reshape your retirement income without any dramatic headlines. If you don't understand what's changing and how it applies to you personally, you may think you're getting ahead when in reality you're barely treading water. Let's start with the change that gets the most attention every year, the Cost of Living Adjustment, or COLA. For 2026, Social Security benefits are increasing by 2.8%. This applies to retirement benefits, disability benefits, and supplemental security income. On the surface, that sounds like a win, especially after years of inflation that stretched household budgets thin. According to Social Security estimates, the average retirement benefit will increase by about $56 per month. Over a full year, that works out to roughly $670. But this is where it's important to slow down and understand what that number really represents. The COLA increase applies to the gross benefit amount, not the net amount you actually receive. That distinction matters because most retirees don't receive their full gross benefit. Deductions come out first, and the biggest deduction for most people is Medicare. This is where expectations and reality often part ways. A 2.8% COLA sounds like a raise, but many retirees will never feel that full increase. Medicare. Part B premiums are increasing in 2026, and those premiums are deducted directly from Social Security checks for most beneficiaries. When Medicare costs rise at the same time as COLA, the net increase in your monthly check can shrink dramatically. For some people, especially those with higher Medicare premiums due to income-related adjustments, most of that COLA increase will be absorbed before the money ever hits their bank account. On paper, your benefit goes up. In real life, your spending power may barely change. Hi, I'm Eric. Let me know where you're watching from. Comment your name and city below. If this video helps you, please like it and subscribe so you don't miss future updates. Now let's move to the second major change, which affects anyone who is still working. In 2026, the Social Security taxable wage base is increasing. This is the maximum amount of income subject to Social Security payroll taxes. In 2025, that cap was $176,100. In 2026, it rises to $184,500. The tax rate itself does not change. Employees still pay 6.2% of their wages. Employers still match that amount. And self-employed workers still pay the full 12.4%. What changes is how much of your income gets hit by that tax. If you earn below the new cap, nothing changes for you. But if you earn above it, you will pay more into Social Security in 2026 than you did the year before. This is effectively a tax increase for higher earners, even though the rate stays the same. More of your income is exposed to the tax, which means less take-home pay until you hit the cap. Once your income exceeds $184,500, Social Security taxes stop for the rest of the year, and your paycheck will increase slightly because that 6.2% withholding disappears. But until that point, higher earners will notice the difference. For self-employed individuals, the impact is even more noticeable because they pay both the employee and employer portions themselves. The third change is one that trips people up every year, and it's especially important if you plan to work while collecting benefits. This is the Social Security earnings test. In 2026, if you are under full retirement age for the entire year, you can earn up to $24,480 without any reduction in benefits. If you earn more than that, Social Security will withhold $1 in benefits for every $2 you earn over the limit. This does not mean your benefits are permanently lost, but it does mean your monthly checks will be smaller while you're working. For many people, especially those who rely on Social Security to cover basic expenses, that temporary reduction can be painful. If you reach full retirement age during 2026, the rules are different. In the months before you reach full retirement age, you can earn up to $65,160 without triggering benefit withholding. Above that amount, Social Security withholds $1 for every $3 earned. Once you reach full retirement age, the earnings limit disappears entirely. You can earn as much as you want without any reduction in benefits, while withheld benefits are eventually credited back through a recalculation of your benefit at full retirement age. That doesn't help much if you need the money now rather than later. The fourth change affects people who are still building toward eligibility for Social Security. To qualify for benefits, you need 40 credits over your lifetime. In 2026, you earn 1 credit for every $1,890 in covered earnings, up to a maximum of 4 credits per year. That means you need to earn at least $7,560 in 2026 to receive the full 4 credits. Most full-time workers hit this threshold easily, but for people with part-time work, seasonal employment, or gaps in their work history, this number matters. If your income is inconsistent or largely unreported, it's possible to lose valuable years toward eligibility without realizing it. The fifth major change involves Medicare, and this is where many retirees feel the squeeze most acutely. In 2026, the standard Medicare Part B premium is increasing significantly. The monthly premium rises by more than $26 compared to 2025. That's roughly a 10% increase in 1 year. For most beneficiaries, this premium is automatically deducted from their Social Security check. This means that even with a COLA increase, your net monthly benefit may not rise by much at all. For some people, especially those subject to income-related Medicare surcharges, the increase in premiums can consume most of their COLA adjustment. This is why so many retirees feel like Social Security raises never keep up, even when COLA is positive. Healthcare costs don't move slowly. They jump, and when they jump in the same year as a modest COLA, the math works against you. The check may look bigger on paper, but the amount you actually get to spend doesn't tell the same story. The sixth change is a tax change that begins affecting tax returns filed in 2026, and it requires careful explanation. A new federal tax deduction is available for taxpayers age 65 and older. This is not a Social Security benefit, and it is not a payment. It is a deduction that reduces taxable income. It stacks on top of the standard deduction and the existing age-based additional deduction. For eligible seniors, this can significantly reduce taxable income, and in some cases, lower or eliminate federal income tax liability. However, this deduction is not automatic, and it is not available to everyone. It phases out as income rises and disappears entirely for higher income households. It's also important to understand what this deduction does not do. It does not automatically make Social Security benefits tax-free. The rules for taxing Social Security benefits based on combined income still apply. What the deduction can do is reduce taxable income enough that less of your Social Security benefits are subject to tax. That distinction matters because misunderstanding it can lead people to assume they owe nothing when they actually do. When you step back and look at all 6 changes together, a clear pattern emerges. Social Security in 2026 is not being dramatically overhauled, but it is being quietly adjusted in ways that affect real money. Benefits rise modestly through COLA, but Medicare premiums rise faster. Payroll taxes reach further up the income ladder. Earnings limits shift slightly, but still penalize people who work while collecting early. Credit requirements adjust upward again. Tax rules become more complex, not simpler. None of these changes alone will make or break a retirement, but together they can easily mean the difference between feeling stable and feeling squeezed. Social Security is not just a check. It's a system that interacts with taxes, healthcare, and employment rules, and every adjustment changes how those pieces fit together. In 2026, understanding these changes isn't optional if Social Security plays a role in your financial life. The biggest risk isn't that benefits disappear overnight. The biggest risk is assuming nothing changed, only to find out later that your income doesn't stretch as far as you expected.